Here's what's coming on this edition of Money Life.
It had gotten up to essentially 85% chance of recession earlier in the year after Liberation Day. Now we're back down to 12%. Part of it, we're running out the calendar, right? At some point, you almost can't have a recession in 2025 just because you've run it out long enough. But it's also been, things have frankly gone better than most people expected.
That's Bill Stone, Chief Investment Officer at Glenview Trust, who points out that you don't make a lot of money betting on things to get worse, so he's not taking that bet right now. But somebody who is betting that things will get worse is Avi Gilbert. He's the founder of Elliott Wave Trader, and he says there is big trouble ahead, though he acknowledges it's not here now, and you don't want to get too cautious too soon. Plus, we've got Corinne Meyer, Vice President at TrueStage, talking payment protection products. We'll help you understand what they are and whether they're right for your situations when you, as a consumer, are worried about what might happen to you next.
Now we're talking business. Let's talk business.
Welcome to Money Life for August the 19th. I'm your host, Chuck Jaffe. Thank you for joining me. We have a great show that, yes, is going to take you kind of from heaven to hell when it comes to the markets, because you got Bill Stone, who's reasonably optimistic, thinks good things can happen, talks about why, talks about not betting against it. You got Avi Gilbert. Well, Avi's been sounding the alarm on a bear market that he compares to some of the stuff we've seen out of Japan, a long, protracted market ugliness that, oh, by the way, he thought would be here by now. The market has defied that kind of gravity. He explains why he thinks it's defied that gravity. And he's very clear that you can expect a bear market to be coming. You can think that there's going to be a major adjustment, and you can say, I see it building, but you don't bet against it until you see enough here. So he'll talk about what it is that he's waiting for and why. And I know that some of you really dislike it when I have folks who, I wouldn't call Avi a perma-bear, but folks who have the bigger or the more extreme forecasts out there. It certainly happens every time we talk to Harry Dent, who we haven't talked to for a while. We've had Robert Kiyosaki on the show once or twice. And I understand you're not necessarily looking for that kind of trouble.
I'm only in the mood for good news today, Ambassador.
Well, I try to be your ambassador of good news when I can be, but this market doesn't always allow it. We will see what is going to happen. It is very much up in the air. We got a market flirting with record highs. That's never a bad thing. Like, you want that to happen, but you've got plenty of people saying, well, it needs to take a breather, and a breather, that's not a big deal. You ride out breathers. But what Avi Gilbert is talking about is he foresees the time when buy and hold, ride out the dips does not work for people. And that's what we're all afraid of to some extent. I'm Chuck Jaffe, financial columnist, your host here on Money Life. This show is independent personal finance talk. We are dedicated to looking smartly at a wide range of approaches and opinions on investing. It's not just about what I like. It's about what you can do with your money, what you can live with. And we try to look at a lot of things. This interview with Corinne Meyer was taped before I had the issue with my chair. You may remember I talked about my desk chair. I'm still sitting in the old one, but the new one is sitting outside waiting for me to finish putting it together. But I talked about how I had purchased a warranty on my chair. I never purchase warranties. I had, in fact, forgotten that I purchased the warranty. That by itself is a reason potentially not to purchase one. Like, if you buy them and you spend extra to have a product protection plan, you need to know that you've got it, and you need to know how it works. And we're talking about payment protection plans, which are like, what happens if you lose your job, but you've taken on some big ticket item that you have to pay for? There are now these payment protection plans, and I want to talk about how they work. Do I want you to get them? Do I think that everything is a situation, right? Go back to when I got Maho, when Gail and I got Maho, our dog, and I made the statement about why we were not buying pet insurance. And at the time, like, David Traynor was putting Trupanion in the danger zone. It made sense not to buy pet insurance. And then Maho jumping around shattered his leg, and we spent a lot of money. Now, we could afford to do it. And in the end, it may still be that as long as he lives the rest of his life out happy and doesn't have some other sort of thing, well, may be the best financial decision. But as I've said, what I would do now, knowing what I know, is I would probably say I'll get a pet insurance policy when I have a puppy and he's super frenetic and just in all out puppy mode. And then as the dog gets older, I might back away from that because you're also making other decisions. The same way that you might say, oh, I just bought a car. I'm going to, of course, have collision insurance on it. But then when you get to where you have an old beater, now I still have insurance on my old beater. And that's because it costs me $8 a year to have collision insurance. That's because they're literally insuring against almost no value. And I know this because I specifically said, I don't need collision insurance on it anymore. And they kind of said, yeah, and it did save me. I had a very minor fender bender where a kid who had just gotten his license had come out, did some damage at my front end by the wheel, and the insurer would have totaled the car. Like we had to do things to make it that they didn't total the car because it wasn't really a big deal, but it was a very minor repair. And I got it done for free, basically, because I'd spent the $8. When it came to my desk chair, the policy cost me about $50, but it saved me $200 when I got it again. So I did buy it on my new chair because I go through a chair basically every 2 years. That is clearly my history. So again, you want to look at all these things and put them into the context of your life and what works for you, but understand how they work and then understand yourself, right? I very seldom sign up for anything where they say, hey, this is free and you'll get it for X number of months and then it'll bill you $12 a month or whatever. I don't do that because I know in my own history, I'm not always good at going, oh, when did that period happen? And then suddenly I'm getting billed for it. The flip side of that is what I've now changed is that if I do take something on like that, I usually go in right away, like on the first day and say, okay, cancel this when the period's over. So there are two things at work. There's how does this product or this protection or whatever it might be work? And then how are you as a consumer? And then the third thing would be, do you need it, right? Any form of insurance or warranty is there to pay for what you can't afford to lose. I could buy another desk chair. Frankly, it's a tax write-off for me. And due to inflation, my new desk chair did cost me a little bit of money. But again, knowing myself as a consumer, a 3-year warranty is kind of short money because I can promise you the chair I bought, I'm willing to place the wager. And the chair cost more than 5 times what the insurance policy costs. So once you're willing to work through it, and we did have to make sure that we got it worked through and it worked out okay, we got the claim done, then it was worth it. Tell me your stories. Let me know if you want more of this kind of consumer stuff as well. Chuck at moneylifeshow.com is how you reach me. But right now, you've reached the financial talk stage. Avi Gilbert, Corinne Meyer, Bill Stone. We're talking technicals when we really get rolling next.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Don't get technical with me. But enough of my technical mumbo-jumbo. Allow me to demonstrate.
Welcome to Talking Technicals here on Money Life. It's where we dig in and try to see what the market's charts are telling the folks who look at the charts differently, technical analysts. And today we are joined by Avi Gilbert. He is founder of the Elliott Wave Trader. It's ElliottWaveTrader.net. We will talk a little bit about Elliott Waves and what they are. I will also point out, beyond that, he, a few years back now, started SaferBankingResearch.com. He started a banking service that, frankly, if you are looking at the banking industry, you should be looking at SaferBankingResearch.com. So ElliottWaveTrader.net. But again, if you're looking for the banking stuff, SaferBankingResearch.net. Avi Gilbert, it's great to have you back on Money Life.
Thank you so much for having me back.
I have to say, you have been talking about problematic markets and where we could get to trouble for quite some time because basically the Elliott Waves were looking for a rally back to record highs near the end of 2022 and then the start of a protracted bear market. And we haven't seen it, but there's been a lot of things that have been forecast that we haven't seen. So let's start with, has any of the things with the market getting back to record highs and defying gravity that you thought was going to impact it, has any of that changed your take, or is trouble still ahead?
Not really. No. The only thing that the market was telling me over the last couple of years, we look for signs that the bear market that we're expecting has begun. But to date, we have not seen those signs, so we cannot get bearish until the market gives us the signs that a bear market has indeed begun. I tell people, look, upside is still very much intact, but you need to be very cautious as you're approaching the market over the coming years. And I'm still very much of that opinion.
Let's talk a little bit about Elliott waves and how they work, because back in the fall of 2022, you were suggesting that if we saw the waves we were going to see, we would get to the start of a bear market that would, 7 years would have been a good outcome. You were looking at potentially decades. So have those things just been pushed back, or are things changing?
If you go back all the way back to about 2016, 17, 18, I was looking for the market to rally as high as the 5,300 to 6,000 region. So we have definitely fulfilled that. And if you look at the very long-term charts, it's clear that we're completing a final fifth wave from, believe it or not, starting back in 1931. So we are actually looking at a very long trend as well as smaller degrees. So we're pretty much still trying to complete the final, as we call them, squiggles in this very long-term path. But until the market actually gives us an indication that a bear market has begun, I can't turn outright bearish, but I can definitely be cautious.
What is the kind of signal you're looking for? I mean, what is it that will be your confirmation that now's maybe the time?
Well, many months ago, I was looking for a solid breakdown, or what we call a sustained breakdown of just below the 5,000 region on the S&P. And we know that back in April, the market came down, spiked that, and then came right back up. So it approached that support back in April of this year. And to date, we still have not gotten that confirmation. So when the market actually takes out the April of 2025 low, that makes a long-term bear market a very high probability in my eyes.
Give us a little bit more definition of what we're talking about when we say a long-term bear market, because you are looking at something on the magnitude of years, not this is the kind of digestible thing that people have been talking about.
Yes, you're 100% right. I'm looking at a magnitude of years. Minimally, like you said, a 7 or 8 year bear market would be the absolute minimum, and we would be extraordinarily lucky if that is all we got. And that would probably be taking us back down towards the COVID lows. Somewhere between 1,800 to 2,200 would be my estimate at the moment. But if we do get the fullness of what I can really expect, you're talking about something that we could be like Japan. We could see a bear market like Japan, and that could actually have us revisiting the 1100, 1000 region on the S&P 500. I know that sounds so outlandish and ridiculous when I say it like that, but the same thing happened in gold a number of years ago when I called for a similar type of a move in gold. And these larger degree levels really wind up playing out the great majority of the time. So in the worst case scenario, you're looking at what could be a 2-decade long bear market, similar to what Japan went through, longer than a decade. And it could take us back down to some ridiculous levels.
We've seen a bull market that is driven by a few stocks. You can have that because of the way index construction works, but you can't necessarily sustain an economy if you don't have some measure of breadth for a long stretch of time. Is that part of what could be happening here? Since we haven't been able to get breadth, we have a bull market that when it breaks down, it just can't stop the breakdown?
I always say that I am just an analyst. I'm not a prophet. I'm not going to be able to tell you what the cause of it's going to be. I can tell you that I maintain an expectation for it. I mean, this is similar to back in late 2019 when I started preparing our clients for what I was expecting was a 30 to 35% drop in the S&P 500. The market did push into early 2020 before we got that. And, clearly I knew nobody even knew the word COVID or anything like that in late 2019 when we started talking about a 35% market drop. So, the reasoning usually comes, or at least the reasoning people put to it, will usually come after the fact. But the market is clearly set up for a very long-term correction. The reason behind it, I don't know what the talking heads will make as the reason. I can't tell you for sure, but I can't tell you even close to why. But all I can tell you is the larger degree structure. I mean, if you look at a very long-term S&P 500 chart from 1931, the bottom of the 1929 market crash, if you look at that bottom and you then look at the rally that we have sustained since almost 100 years, I mean, it pretty much is straight up. So I think we are due for a correction of that magnitude bull market. So again, the reasoning, I'm not even going to attempt it.
The argument against that from a lot of the people I talk with would be, we're looking at AI as the next industrial revolution, something along those lines. Why don't you look at it that way? What is it that when other people can see or see something overcoming it, why do you say, no, this is basically inevitable?
Well, these same people back in 1999 were saying that the internet revolution was the latest industrial revolution and that will take the markets going like crazy. Well, we did get a lot of huge benefits out of the internet. I mean, it changed the world, but it also led to the following year in 2000 starting what was a 9-year bear market, because effectively the market went sideways for the next 9 years. And that is with this revolution of the internet. So the AI revolution is nothing different. It's a nice story. Will it revolutionize the way we do business and work? Sure, it absolutely can. It doesn't necessarily mean the market is going to continue along its merry way in a linear fashion in the same way that they all maintained that expectation in 2000. I believe you're going to see the same thing here.
In the middle of that kind of bear market, there are going to be times that, just as you've seen it now when it's the other way, where you've said, hey, I see a little bit of turbulence or what have you, but I could see a rally. Or as you said at the start of this, you can't really get bearish at a time when the market has been this bullish. Functionally, there will be ways to keep moving forward. I mean, that's what you're trying to help people do as well in or when we get to this big downturn, right?
Well, yeah, absolutely. I mean, the best example that I can give is when you look at the market from 2000 to 2009. From 2000 until towards the end of 2002 into early 2003, the market was in decline. So that was a first leg down. Thereafter, we saw a multi-year rally until we got to the 2007 high. And after that, we then saw a market crash into the 2009 low. So, but if you look at the chart, effectively the market went sideways. So my expectation is you're going to see a lot of similar type of action like that, but many times over. You're going to see a large market decline, followed by a multi-year rally, followed by a crash. And I believe we'll see that several times throughout the long bear market, ultimately making our way lower and lower, meaning that the rallies back will be taking us to lower and lower levels from which we will then see a little crash and then rally back again, not quite as high, crash again, and so on and so forth. So yes, there's going to be opportunities. There'll be tremendous opportunities during this type of bear market. But for those that are buy and hold, buy and hold, buy and hold, the market always comes back in a Pavlovian manner. I think they're the ones that probably will be having the most difficult time during the environment that I'm foreseeing.
I know it's not going to make folks comfortable, but at the same time, it's important that they hear it, understand it, and manage their portfolios accordingly. Avi, really interesting stuff. Always great to catch up with you. Thanks for coming back to the show.
Thank you for having me again.
That's Avi Gilbert. He is the founder, Elliott Wave Trader. Go to ElliottWaveTrader.net. Again, if you want to learn more about his banking research, it is SaferBankingResearch.com. We're just getting started on the August 19th edition of Money Life. We'll have some better news for you, I think. Stick around. This is Money Life.
Verify is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at Verify.com.
Welcome to the other interview on today's show. And we're digging in on something that, well, it's actually been around for a while, but it hasn't necessarily been popular. And it's becoming a trend because we are looking at payment protection products. With consumer debt up, with consumers feeling stretched, with interest rates having stayed higher for longer, with inflation still high, with an uncertain macro picture, with plenty of people, statistically at least, living paycheck to paycheck. Well, one of the financial products that has been moving up in terms of people's priorities and people's idea of what they could do is a payment protection product. And so we want to discuss them because they kind of are similar to the way you might buy travel insurance, but instead you're doing it when you finalize some form of a loan. Here to discuss it, Corinne Meyer. She's vice president at TrueStage. TrueStage, of course, works with credit unions. And so this is a product that if you're a credit union folks, you might be getting the TrueStage version of it. But if you want to learn more about TrueStage and what they do, it's TrueStage, TrueStage.com. Corinne Meyer, welcome to Money Life.
Pleasure to be here, Chuck. Thanks so much for having me.
Let's talk a little bit about the basics of how payment protection products work, because functionally it's like credit insurance or insurance against something happening that makes it that I can't pay off my debt. Help us understand the way this works and what's covered and what we're looking to do as consumers so that we can determine who this might be right for and not right for.
Yeah. So if you think about payment protection to start, it really starts with this notion of, hey, we want to provide stability with the unexpected. And if you think about debt, Chuck, when you and I take out debt, it's really based on perfection and reliability, exact amounts on exact dates where we need to make payments. But as you mentioned, consumers' wallets are tightening. And the ability for us, when our budgets are financially stressed, to make exact amounts on exact dates can be hard. And so that's what we want to help with. And so we really protect against kind of consumers' top worries. So life insurance. So if you pass away, we'll pay off your loan. The other two perils that we protect against include involuntary unemployment and disability. So if you're unable to work because you broke your arm or you had surgery, we will make your loan payments for you until you get back on your feet. And the benefit of this is the coverage is included in your loan. So you're making one payment to the financial institution every month for both your loan and the coverage that gives you peace of mind if something unexpected happens to you.
But this is an add-on that you, the consumer, have to decide that you want. And while you're paying it within your loan, if you weren't paying it, your costs would be a little bit cheaper. So how much does this add to a loan? Because those, there's varying levels of insurance, and insurance is kind of like, a leaky roof works just fine on a sunny day. This is the kind of thing where most of us get insurance that we hope never to use. This is that kind of insurance. So how much does this add for folks who are trying to think about whether this adds peace of mind?
Yeah, great question. So on average, I would say it's about 3 to 12% of your monthly loan payment. And so the cost can vary, and I would say there's two main things that influence the vary of that cost. What protection you choose, Chuck, do you want life, disability, and unemployment? Or are you comfortable with just life insurance, for example? The other impact to kind of that cost range is, am I protecting just myself or myself and my co-borrower, for example, my husband for me? So if you take like a $500 loan payment, that would be about $15 to $60 a month. And so I look at that when you think about your budget and I say, well, that's like my husband and I going out to eat one last time a month. Is that peace of mind worth it for you as you think about that overall loan payment?
But what that means is that we're looking at something fairly significant, like we're doing this on a car, et cetera. And how much, when we look at that, insurance, when we cut it up and make it fine, tends to be expensive. It's kind of akin to travel insurance. If you've already got life insurance, you don't need travel insurance to give you life insurance. You need travel insurance because, you were worried that you'd get sick and you'd have this big expensive trip and you wouldn't be able to make it. So, is there a level of transaction where you tend to find this is the sweet spot from here on up? People get more interested. And then is the value proposition making sure you get coverage that you don't have? Because if what you need is life coverage, if you've already got life insurance, I can't imagine a case where you'd go, yeah, I want to pay extra for extra life coverage to pay off a product.
Yeah, so I think a couple things you talked about, Chuck, there I'll hit on is one, it is voluntary, so the consumer can opt into it, and you have the right to pick which protection is right for you. So, right, in your situation, if you do have the appropriate amount of life insurance for your family, you may choose not to add that coverage. Maybe you just want to add disability or unemployment. As we look at kind of the overall economic situation for individuals, the number one driver we see to say, hey, am I likely to elect this coverage or not, really is that notion of, do I feel like I'm living paycheck to paycheck? And so overall, our recent research shows more and more consumers are living that way, right? 9 out of 10 of them are worried about their ability to make their loan payment. And top worries include things like job loss or inability to work due to illness or injury. And so it's really, I think, an evaluation of that first, and then say, hey, can I afford that as I think about my overall loan payment?
Yeah, because you're living paycheck to paycheck. This is an extra expense. But again, if you're worried about job loss, and like, how do we define job loss? Like, this is not something where somebody can go, hey, I really kind of, hate the office space thing. I hate my job and I don't think I'm going to go anymore, is not the kind of thing that's going to trigger this insurance. So how are we defining job loss? Is it got to be, I'm going to unemployment, I'm doing whatever, not my fault?
Yeah, great call out. We're going to look for a couple things for eligibility when you take out that loan is to say, hey, are you working at least 25 hours a week? And then for kind of that loss to be triggered, you're correct. It's that involuntary unemployment. It's not me waking up tomorrow and deciding I don't want to work.
Is there a sweet spot in terms of size of transaction? I mean, obviously, we're talking about a percentage, so it's not that the payment is necessarily going to be big on a small dollar transaction, but is there a spot where you tend to find once we get past this, that's where people are worrying?
Yeah, so if you think about the average size of transaction today, an average auto loan in 2025 is 41,000, so up from 7,000 just 2 years ago. The average home equity loan is actually over 105,000 right now, so up 34,000 from just last year. So as those balances have increased, we've seen kind of the ability to continue to protect consumers maintain. But those average balances are probably in that 10 to 100,000 that we see folks taking out coverage on.
When you've added this kind of protection to something that you're doing, can you remove it midstream? Can you get to a spot where you say, okay, I haven't paid off the loan, but I'm now at a spot, because I always say insurance is about protecting what you can't afford to pay for yourself. So if you're looking at, I bought a $40,000 car. I think you just said was 41,000 is the average car loan. Okay, if $40,000 is the average car loan, and I'm paying this off over 5 years, in the 5th year, my average is way less. I could do less. So is this something you can remove as you figure out the finances going forward?
Yeah, absolutely. And so we want to make it really easy to add coverage, but you can also remove that coverage once you have the loan. So it'd just be as simple as contacting the financial institution to cancel that coverage. That's not a problem.
And then in terms of where this is offered, et cetera, I mean, there are going to be some members of my audience who are like, really, I've never purchased anything that this was offered on, but I could see wanting it based on my circumstances or whatever's going on. Do you ask? Do you tell? I mean, obviously you guys have a product, but that doesn't mean that every credit union is offering on everything that I might be doing. And, I may not be using a credit union as my lender. So how do I find this if my bank has never told me about it?
Yeah, I think there's kind of two pieces there. One is, absolutely ask your financial institution for payment protection. You mentioned earlier, TrueStage has a long history of working with credit unions. Over 64% of our credit unions are offering this type of payment protection. So you can definitely ask for it. I would say we're also really focused on making sure it's accessible. So you mentioned travel insurance earlier, Chuck, right? Since COVID, we can't buy an airline ticket without being offered travel protection on that airline ticket. We're working really hard to make this product accessible digitally as well, so that, hey, when you are applying for that loan from your financial institution, it's really easy for us to add this coverage within that loan flow and make sure that you have the opportunity to decide if that coverage is right for you or not. Because sometimes I buy, you know, travel insurance and sometimes I don't. It depends on the payment, the situation, how you're feeling about the finances at that time. We want to have that same sort of accessibility for this coverage as well.
And the disability coverage, what are the basic terms there? Since we talked about the job loss, we should make sure people understand what it is that you're looking for in terms of if you've got health issues.
Yeah, and so largely for these products, there's not any sort of underwriting. We are going to look for that overall eligibility. And again, the eligibility for disability is very similar to involuntary unemployment, so 25 hours a week of work. And then if you have an event, right, a lot of people think about, a long-term disability, I get in a car accident and can never work again. But we also cover things like I have hip replacement and I can't work for 2 months. And so looking at that kind of overall inability to work due to an injury is what we'll be looking at.
And would folks in that kind of case, if, I know some guys who are going to have hip replacements or knee replacements, but they don't know when. Is this a case where if you knew you were having it, you're not going to get the coverage because there's not any underwriting? So I would assume this is a case where that actually could be valuable if you said, oh, in the next year, I'm going to have this surgery and I don't know how it's going to play out. Or is that not covered?
Yeah, you're right. There's no underwriting. There can be, based on a financial institution, like a waiting period to say, like, hey, you don't have a claim within the first 60 days. I think overall, though, right, you're not going to go say, hey, I'm going to take out a loan just so I can have a payment made for my hip surgery. And so it's really thinking about, hey, is it good for me to have this peace of mind when I know I'm going to have this reoccurring payment on a tight budget? And does that make sense overall?
Yeah. But I'm just thinking factors that would go, okay, do I need it? Do I not need it? Yeah, the life of this loan is X amount of time. I'm not getting any younger, that kind of thing.
Yep, absolutely.
Corinne, really interesting stuff. Thanks so much for joining me on Money Life to talk about it.
Appreciate the time, Chuck.
Corinne Myers, Vice President at TrueStage, TrueStage.com, TRU Stage.com if you're looking for more information. And you can find information on their payment protection products if you're looking at the website. I can't insure you against bad things happening in your financial life, but I can ensure that Money Life will be right back in just a second. So we'll take a quick break, and I promise the payoff is more talk on the other side of this break.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Welcome to the big interview on the August 19th edition of Money Life. Returning to the show now, Bill Stone. He is Chief Investment Officer at Glenview Trust. If you want to learn more about him and the firm, if you want to find his commentaries, which are worth looking at, but particularly worth looking at when you hear about what's going on at Berkshire Hathaway, because he is a big follower of Warren Buffett and a big believer in Berkshire Hathaway. So he's always being asked to comment on everything that's going on there. If you want to find that, but much more, like all the stuff we're going to cover here, GlenviewTrust.com. Bill Stone, it's great to have you back on Money Life.
Well, thanks for having me.
Let's start with where we are right now. We will get into Berkshire and Buffett and some other things, but we've seen a market that's successfully gotten back to record high levels, climbing the wall of worry, all those other sorts of things. Are we at a spot where there's still, room to grow, or are we at a spot where we need some sort of a pause, whether it refreshes us or it just allows us to reset?
Yeah, I mean, it's a tough one. I mean, I want to say, or I don't want to say it, but I do think we may need a bit of a pause. I think we've gone from I like to watch now the poly market odds of recession. Had gotten up to essentially 85% chance of recession earlier in the year after Liberation Day. Now we're back down to 12%. Part of it, we're running out the calendar, right? At some point, you almost can't have a recession in 2025 just because you've run it out long enough. But it's also been, things have frankly gone better than most people expected, despite the tariffs. And obviously you backed off some of the tariffs, or I don't want to call it the worst of it. I'm not trying to make a judgment on them, other than there's certainly, I'm just going to say, there are attacks on somebody, so that tends to at least do something, or soften economic activity at the margin. But either way, we've come way back. You've had earnings just phenomenal here in the second quarter, way better than expected. The reignition, or I don't know, there was some questions right around that Liberation Day around whether artificial intelligence was maybe fading, or they were going to slow down CapEx there. All that has obviously gone the other way, that the CapEx continues to pour in, seems to be more and more usage of artificial intelligence. So yeah, I don't know. I don't know how much better it can get. It can always get better, but on the margin, I'd be a little bit more cautious at the moment.
Let's talk briefly about Buffett and Berkshire Hathaway, because there were some interesting moves in the second quarter earnings report. We also, of course, are kind of anticipating Warren's retirement. So help us start there. Are we coming to the end of Berkshire in the news cycle, or will it still be big news? And maybe, 2 years. It'll still be big news for the first year, because everybody's going to want to see what they're doing and sort of say, hey, this is a Warren move, or this isn't a Warren move, or whatever it might be. But 2 years from now, will Berkshire, under Warren Buffett's replacements, be the same newsmaker that it is now?
Well, I think you have to say it's not likely to be the same. Now, that being said, it's still one of the biggest companies in the world, and certainly has, one of the biggest piles of cash out there. And that isn't always going to be the case necessarily, but let's just say right now. So there'll certainly be market movers. So in that sense, I think it'll still be a big news item. But, there is nobody like Warren Buffett. So I do think some of it will fade. Now, that being said, he said, even though he's retiring from the CEO role at the end of the year, I don't anticipate he actually leaves being part of Berkshire Hathaway. In fact, he said he's not going to, I guess, unless he has to. So my guess is he'll be carried out at the end. That's the only way he's really leaving. So some of that may continue. He did say he's not going to speak at the annual meeting next year in May, or at least not going to be up on stage for the question and answer. We'll see if that stays that way. That's the one where I'll be interested, because I'm going to go as like I've gone for whatever the last 20 years, but I'm going to keep seeing it through at least for a while. But I always wonder how long I'll be willing to go to Omaha if Buffett's not on the stage. Now, will I watch the cast online? Sure, I will, but we'll see. I'm going to leave my mind open. I'm interested to see how it plays out.
Yes, but watching the cast online versus being there for any company that you would go to makes a company just another piece of the portfolio.
Yeah, I agree. I mean, there's something to that community there. Like, why do you think I've gone back that many years in a row? Because obviously I could have just watched it online for the last however many years they've been doing it online, but it is special to me. So I hope it continues to be that way. We'll see.
That said, what did you take from the moves? Because it was a really interesting quarter. I mean, I'm certainly not the Berkshire follower that you are, but of course the headlines were, wait, there's 5 new holdings in the portfolio. And at the same time, the company was selling more stock than it was buying. So trimming what it had, buying some things that it thought were interesting was the approach. Is there much that you take out of that activity, or is it so individual to the company, so bottoms up, that it's not a market statement?
No, I guess I think the only market statement is, they continue to struggle to find things that I always say in their circle of competence. So, what has really been the, earnings driver in this market has really been the hot thing is obviously been technology and artificial intelligence. That's clearly not them, right? So in fact, as you note, they were selling things they already own. One of those was Apple. So they trimmed some more Apple. They sold some Bank of America. That's obviously not tech related, but certainly took some profits there. I do think it's interesting. I guess my big takeaway, at least as I think about some of the change or some of the things they bought, was just some of it fits into this, you know, I'll say United Healthcare, I think fits into this bucket because that was one of the biggest, I think that was the biggest buy, was really the bucket of I'll call it a franchise business that's run into some really difficult short-term headwinds. We can debate. And honestly, I looked at the stock. I didn't pull the trigger to buy it because I'm a little worried that I'm not sure it is temporary. We'll see. But that to me is, kind of if you think of the Warren Buffett, where he's made some of the best success is buying things that are, great brands, quote unquote, franchises, whatever you want to say, short term down their luck that he believes will rebound. Now, whether he was the buyer of this or one of his lieutenants, who knows? Pretty small for him. But either way, I think that's the underlying there. And it kind of shows that they have this longer time frame than most portfolio managers. Now you've seen people kind of chase it now. But I also say that about the housing stocks. They bought some of the housing stocks, the single family home builders, Lennar, D.H. Horton. And I think that one's another one, again, short term, I was like challenges in the housing world. But if you say, hey, we're really underhoused, and which we are, and our housing stock's getting old, which it is, suddenly, if you got a longer enough time frame, and actually what's interesting, those companies we don't own them right now. I wish I did, I guess, but ahead of them, but have actually been quite, decently profitable despite the kind of contraction in that marketplace in new home building. So they're running themselves better than they used to. So it's interesting if you have a long enough time frame.
In terms of where you're at right now, how broad do you think whatever upside we have can get? And do we need to have something that is broader? Because we went from a market last year, actually the last 2 years, that was really driven by rate cuts. This year, it was clear that it was going to be earnings, and earnings have come through. But of course, it has been the biggest and the best that have really been the water carriers for the market. As we move into the next stage, if we don't see things broaden out, is a downturn at this point pretty much inevitable? Because rate cuts, while we're likely to get them soon, and we'll talk more about that in a second, are not going to have the same impact they did a year ago. And earnings, well, you got to have it on the paper to be able to do it. I don't know that they can continue this good forever.
Yeah, and it's a tough one. So can the market continue to go on without a broadening? It can if the mega cap techs continue to go because they become such a large portion of the market. Now, I don't like it to necessarily to count on one, I'll say relatively small sector. It's large in market cap, but small in number of stocks. That's not an optimal situation. So I do agree. I'd like it to broaden out. And maybe there's some good news that some of these companies are going up against some maybe easier comparisons, et cetera, because again, they haven't exactly set the world on fire. When you look underneath the hood, it has been, as you mentioned, primarily just this relatively small number of very large tech stocks that have been really the ones that cause the earnings to look extremely good. And you can say it again about this quarter. So let's just say the rate cuts themselves may not necessarily show up in the market, but if it gets us through this kind of softening in the economy and we don't go into recession, can keep kind of earnings growth going overall, that may do it, right? As you know, I never get too down. I might be on the margin a little less aggressive at any given moment, but I'm smart enough to know the numbers that betting against things to get better over the long run is not a very smart bet. So, I try not to, despite being worried sometimes, get too down on things. I just kind of tilt a little bit. Like right now, I tilt a little bit less aggressive, buy things like Berkshire Hathaway where you don't have to worry about it and some things like that. I think that is the place to be.
Speaking of place to be, your take on Europe and international investing, because they've had a hell of a year, but I will say that the response here on Money Life, talking to experts, has been mixed. There's one school of thought that says this is the rally we've been expecting, but oh, by the way, it's ending. The other one says this is the rally that was inevitable because of valuations, and the valuations are still cheap. Which school are you in?
So full disclosure, we own almost no international here. We haven't for years. And really, it's more when I think about it is we'll own individual international companies because we know the U.S., doesn't have every greatest company in the world. But I think the issue is when you look at this year, most of this outperformance of international really came from currency. And do you really want, are you good enough to play that game of knowing when the US dollar is going to be stronger or weaker? And I try and stay out of the politics of things. And, a lot of people kind of extrapolate based on that. I don't know. I can't do it. So I don't play it. So I think that's one. Two, when you look at international, and I'll pick on Europe in particular, a bet on Europe is a bet against technology because we know, they have a few big tech companies, but if you look at their big tech companies, those have traded like ours and done extremely well. When you set it aside and look at the markets, if you're trying to look at a broad market ownership, if you want to own the broad Europe versus, not owning the US, you're betting against technology. And again, while I might think technology is, it's pretty expensive, they are great companies, or at least these US mega caps. So I really don't want to bet against them, to be honest.
Broadly, because you look at everything, we've got a market where right about now you're still getting paid to wait when it comes to fixed income. But of course, we're expecting a rate cut, although we've said we don't know the exact impact. For you right now, if somebody is nervous, and we have been watching a market climb a wall of worry, is fixed income going to still be even remotely attractive once we see the rate cuts, or are you locking stuff in now? What's your take on where fixed income should be?
Yeah, I mean, I think it's, at least like you said, you're getting paid. And if you can, maybe you move it out a little bit. I wouldn't go too far out in terms of the maturity, just because I'm, frankly worried about the fiscal situation, not just in the US, but across the globe. I'm worried on the really long end of things that you may see more pressure on those yields. But if you move out toward the, 5-year period, et cetera, around in that intermediate, I actually feel pretty good. At least you've locked in if you start to see the rates come off. The other thing we kind of hide out in some short-term tips and say, well, there's our kind of insurance if things go horribly wrong on the inflation front. We don't have a lot of interest rate risk, but we have, kind of CPI insurance, so to speak, on that side. So I think some of those are interesting too.
When it comes to these conditions, there are a lot of things that we've expected that just haven't come to fruition. Starts with recession that we thought we might be getting, that, only after we went through Liberation Day did people think it was actually coming, and now they've all backed away from that. And as you pointed out, there's only so much time left in the year where we could even have one this year. But we also haven't seen the bigger inflation that folks thought we'd get from tariffs and the rest. In your mind, is all that stuff coming? Has it been delayed? Or is there a reason why it's not coming that has more to do with either the economy or how we keep the numbers, things along those lines?
Yeah, I guess I steer away from any conspiracy on it. I just think it's that you had we always said, hey, these tariffs are going to get swallowed by the original international manufacturer, the distributor here in the US, or the end consumer. And I think it may have gotten spread through the whole chain, and it just maybe doesn't show up really big. The other part is, the inputs into things are not generally as big as the labor that's added on top of it and things like that in terms of total cost. Again, I'm generalizing, obviously certain things that is not true, but I would argue on the bigger picture, it's all the labor costs and everything else that actually are a bigger part of the cost of many goods versus the bare materials that went into it. So, it may not show up in a horrible way. Again, I think we've got clearly some pressure there, but at least right now workable, and we'll see. And certainly a softening in the labor market then probably, at least helps the wage pressures, although, higher wages are a good thing in terms of keeping people spending.
You mentioned we're running out of time to have a recession this year, but we're getting to the time where you are starting to forecast what's going to happen next year.
Yes.
So while plenty of people thought this year would be, relatively benign, give us gains, but not necessarily what we've seen in the last 2 years, they certainly didn't expect the path we've had to go from January to where we are now. Lots of people right now are saying, we'll get through some volatility, be pretty benign for the rest of the year. But what's your early take on what's coming in 2026? I mean, trouble hasn't been put off forever. So what's it going to take for us to see trouble?
So, I mean, I think when you look at the labor market, you're clearly seeing softening. Now, it's not recessionary yet, but the problem is usually the labor market doesn't just go sideways. It's either probably getting better or, getting worse until it, I'll say, drops off the table and then leads to recession. So the question mark for me is just to see how the Fed, and it's not all on the Fed, but kind of how the economy, let's just say, reacts to. I do believe they're going to cut rates, or at least start cutting rates here in September. How it reacts to that, and we could get through. Could just be a soft patch, and we'll see what happens. I guess I'm going to say I don't know, so I'm just going to keep my mind open. I think part of the reason why I said earlier I was a little more cautious is just stocks are pricing in really a very low to no chance of recession here because, with the multiples we've got on things, you kind of need the earnings to continue to catch up with the multiples. And that's why I think you just got to be a little careful, again, not forecasting a recession, but being mindful of what's already priced in. And if a lot of good news is priced in, that's usually when I get, again, less excited. I get more excited when a lot of bad news is priced in.
You get more excited when a lot of bad news is priced in. So that means that ultimately we keep riding this wall of worry and we prepare for the wall of worry. But as much as you can't really say a market at record highs with what we've been through is business as usual, you're saying this is business as usual, aren't you?
Yeah. I think you just continue to obviously rebalance back and make sure that you're in a good place that you can get through if we do have a downturn. Because I think, the danger now is, we talked about the good news is that the U.S. market is dominated by technology. And that's actually why we've outperformed, for a number of years. But it's also the danger, right? I truly believe artificial intelligence is, a big deal. But even a big deal, as we know, can turn out to get either ahead of itself. You end up putting too much into CapEx because they get too excited. And then all of a sudden you hit the wall and they've got to pull it back and you see bigger pullbacks than you would otherwise see. I just, mentally, because I've been through enough of these cycles, get a little, while I enjoy the ride, you got to make sure you're positioned in the right spot that if it hits some bumps that you don't get knocked out.
Given that we're talking AI, are you preferring AI companies at this point or AI adjacent? Which is your preferred play?
I guess, I would say in the short run, or I don't know, even intermediate run, we're still probably more in the AI companies like a Microsoft. And when we still own NVIDIA, we've frankly been continuing to trim NVIDIA just because it's gotten to be such a big part of our portfolios, not because we don't like it. But like the real question is around these companies, the software companies that are utilizing AI that have just, really suffered here. And because it does seem like the power, so to speak, has gone back to the primary AI companies, thinking that maybe these other software users of AI, think of an Adobe, a Salesforce, ServiceNow, things like that are going to be perhaps at a disadvantage, that they're going to have competitors come in, AI, driven competitors come in and take away their business. We are looking in those areas for opportunities that eventually maybe it gets too far. In the short run, we're not yet ready to get aggressive in any of that, but I think you should be watching there that maybe, it'll get pushed too far, and then, maybe an opportunity in some of these firms that, you'd consider a good franchise that hopefully in the long run can take advantage of it.
Bill, great stuff. Always is when we catch up. I appreciate your time. I know that as we watch it all play out, you get your forecast together and everything else for 2026, we will be talking about it down the line. Thanks for coming back to the show today.
Anytime. I look forward to it.
That's Bill Stone. He's Chief Investment Officer at Glenview Trust. Go to glenviewtrust.com to get more information on him, the firm, and to find his commentaries. And we will be right back to wrap up this edition of Money Life. Stick with us all the way till the end, which is coming right after this message. Back to wrap this one up. Really some interesting conversations. We always talk about crossover when it comes to stocks and individual names. But I think you need to look at some sentiments, right? So Bill Stone talked about how he couldn't get behind United Health Group, right? UNH, even though Warren Buffett is. It came out that was the biggest purchase in the second quarter report from Berkshire Hathaway. Bill Stone, well, he'll have exposure to UNH through any Berkshire shares that he owns, but he said, he wasn't going to buy it individually. He couldn't go there. And to him, it was a passing comment, and it wasn't related to anything else. But if you listen to the show, you know that Jeff Mullenkamp from the Mullenkamp Fund put an avoid on UNH. And he did it on the day that then the news came out later. It was on the show that appeared on the day when the news came out about Buffett and others buying UNH. And again, we always say that disagreement makes a market, but you have to decide what you're comfortable with. And if you think about it like this, although Warren Buffett is not known to be a particularly high-risk investor, we're talking about where do you feel like, he's taking too much risk for my blood. It's that side when you're playing the poker game and somebody makes a raise on the stakes and you go, that's too rich for my blood, at least with what I'm playing with. So it was an interesting point. We had a little bit more of that in other ways. I know I should have taken a note. I usually am taking notes while we're doing interviews so I can remember things like this, and I whiffed on it. There was one that I thought, hey, tomorrow on this show, I know I haven't given you a great tip-off for what's coming, but I really like what we've got coming. Lawrence McDonald of the Bear Traps Report will be here. And it'll be a good juxtaposition of what's going on with like Avi Gilbert, because Avi is obviously more of you can't say perma bear, but he's looking at a long-term devastating bear market that he thinks is going to happen at some point, regardless of everything else, that eventually it goes there. Now, eventually he may be proven right if you wait long enough, but he could be wrong in the interim. And I know that some of those guests bug you. Well, Larry McDonald is not a perma bear, and he is a really interesting market observer who, by the way, has been spot on his calls on politics, much to the chagrin of many of us. He was the first person that told me on the show that he thought Donald Trump was going to win at a point when everyone expected Hillary Clinton to win. But we don't just have him. Dan Sotiroff from Morningstar will be going off the news with us tomorrow. You may or may not have heard the news that Vanguard's latest foray into ETFs is an important first for the company. They're unveiling 3 active ETFs. We're going to explore whether it has bigger meanings and more. So that's on tomorrow's show. If you missed that news, we'll fill you in on it. So that's all coming tomorrow. Meanwhile, if you're looking for something to celebrate today, it's National Aviation Day. And then everything else is food related. It is National Hot and Spicy Food Day. Love hot and spicy food. It's National Potato Day. Love potatoes. It's Black Cow Day. Yeah, it's not that kind of black cow. It's black cow, of course, a root beer float. And it's National Soft Ice Cream Day. My guests today were Avi Gilbert, founder of the Elliott Wave Trader, ElliottWaveTrader.net for more information. Corinne Meyer, vice president at TrueStage, TruStage.com. And Bill Stone, chief investment officer at Glenview Trust, online at GlenviewTrust.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from yesterday's show and Ryan Dietrich of the Carson Group. And I love this one. He said, the market doesn't care about good or bad. It cares about getting better or getting worse. Well, that's what you should care about too. Like every day, let's strive to be a little bit better, not be worse. Do that with your life, but also do that with your portfolio, and it'll help you remember that until we do this again the next time, best thing you can do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil. You must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Okay, you finished now, right?